This is Dr. Rob with just a few words to say about how impairment interacts with revaluation. As you know, impairment gives rise to an accumulated impairment contra account in the cost model, whereas revaluation directly adjusts the asset upwards or downwards with effects to loss on revaluation or revaluation surplus. However, it is important to understand that the impairment measurement rules continue to apply for revalued assets. So let's firstly just think about how they work. If you have a look at IAS 36, paragraphs 59 and 60, in Australia, those are AASB 136. AASB 136 says we must still impairment test revalued asset. So essentially what it's saying is an asset must never be recorded at above its recoverable amount. And if there's an impairment, then we treat that as revaluation decreases. So let's have a look at how some of these numbers might pan out. What I've got here are some numbers where we have fair value, but also fair value less cost to sell. Now remember that recoverable amount is the maximum of fair value less cost to sell and value in use. So if you have a look at the recoverable amounts that I've listed here, they are the maximum of the two. So 810, 950 yields recoverable amount of 950. 810, 860 yields recoverable amount of 860. With the last one, fair value less cost to sell, or 830, the value in use is 800, that yields a recoverable amount of 830. Now the question then is, what do we revalue the asset to? Normally we revalue to fair value if the recoverable amount test doesn't bite. And as you see in years 1 and 2, the recoverable amount is either the same or higher than fair value, so we can basically ignore it. However, in the last year, we've got a fair value of 880, so in principle, we want to revalue the asset to 880. Up or down, it depends on where the carrying amount is now. But in practice, there's a recoverable amount that is 830, and we can never record an asset at above recoverable amount. So when setting the target of the revaluation process, we choose fair value unless recoverable amount is smaller. If recoverable amount is smaller, then the target of the revaluation is the recoverable amount. That's what we want to get the carrying amount to. So in the first year, we would revalue to 860, in the second to 860, but in the last one, we would revalue not to 880, but to 830. Okay, so how does this work out when we come about to thinking about the journal entries? Well, the cool thing about IAS 36 is it says, look, when you do an impairment loss of a revalued asset, even though the impairment rules determine the target, the destination, the amount to which you revalue, the impairment loss itself will be treated as a revaluation decrease in accordance with AASB 16. So what that basically means is the impairment process only affects the number. It doesn't affect the journal entry. So you work out, is the number bigger or smaller than the carrying amount? If it's bigger, you're revaluing up. Is the destination bigger? So let me just make it clear. Look at fair value. If fair value is smaller than recoverable amount, you revalue to fair value. If fair value is bigger than recoverable amount, then recoverable amount gives you a sort of ceiling, and you've got to revalue to the target, which is recoverable amount. So once you know the amount you're going to revalue to, the revaluation is normal. If it's downwards, it's a loss on revaluation. That's if it's a fresh one. If it's a reversal of a previous upwards, of course, the debit will go to revaluation surplus, and the credit goes to the asset. So see, even though impairment is having an impact on the asset, there's no accumulated impairment account, there's no impairment loss account. The impairment is essentially treated as a loss on revaluation. Now let's just come back to that previous slide for a second. Have a look at why recoverable amount is smaller than fair value. The way I've set up these numbers is actually quite interesting. What I've done is I've set up a fair value less cost to sell where there are substantial costs to sell. In fact, I've rigged this so that the cost to sell are 50,000 in each case. So what that basically means is that it is possible for the recoverable amount to be smaller than fair value because of those costs to sell. Now imagine that costs to sell was zero. If costs to sell was zero, then there's no way fair value less cost to sell could be smaller than fair value. And remember that recoverable amount is the bigger of fair value less cost to sell and value in use. So if fair value less cost to sell was equal to fair value, recoverable amount would be the bigger of fair value and value in use. So value in use is bigger than fair value. It's okay, you can revalue to fair value because recoverable amount is bigger. If fair value is bigger than value in use, then recoverable amount is fair value. It's okay to revalue to fair value because it's also a recoverable amount. If recoverable amount is value in use because value in use is bigger, it's okay to revalue to fair value. In fact, the only time the recoverable amount will be smaller than fair value is if there are substantial costs to sell and value in use is smaller than fair value less cost to sell. That's the only circumstance. Okay, so that's how impairment interacts with revaluation.